Imagine never having to go to a bank for a loan again. Imagine paying yourself back with interest instead of a lender. That's what it means to be your own banker, and I'm going to show you exactly how it works. Hi, I'm Sue Cunningham, the Wealth Protection Lady. I help people protect and grow their money using insurance-based products such as Index Universal Life and annuities. When you borrow money from a bank, they set the rules. They decide the interest rate, payment terms, and penalties. But what if you could flip the script? Here's how it works. You put money into a max-funded Index Universal Life policy, or IUL. Your money grows tax-free. When you need access to your money for a new car, a down payment on a house, an investment, or even a retirement income, you don't withdraw the money, you take a policy loan. Now you are in control. You choose how fast you pay it back, and the interest goes back into your system, not the bank's. And the best part is, even though you took that money and spent it, it's still in your account earning interest, as if you hadn't taken a loan at all. Sound too good to be true? Well, it's the difference between what you can do with a life insurance policy that you cannot do with an investment account. The wealthiest people, corporations, Fortune 500 companies, banks, and even hospitals use Index Universal Life as a core part of their financial strategy to keep their dollars moving in two places at the same time. Let's take a look at an example. This life insurance carrier offers 3 different loan types. The fixed loan is the only loan available in year 1. You do not want to take this loan because when you do, that loan amount comes out of the policy altogether. Starting year 2, you can take one of the participating loans this carrier offers. The difference with the index loan is that loan amount goes into the indexed loan account, and then you are credited interest based on the performance of that account over the past year. The index loan account is a blended index, and it's all in the stock market. So you do not want to take this loan or keep it when the stock market isn't performing well. I recommend the variable loan. Variable loan rates are based on Moody's corporate bond yield, so they are interest sensitive. Right now, this carrier is charging 5.25% for the loan and crediting back 5.75%. And they always credit back 0.5% more than what they charge. When you take a variable loan, that loan amount never leaves your policy. It remains in your account, earning interest as if you hadn't taken a loan at all. I always structure IULs for the lowest death benefit the IRS will allow, which maximizes cash accumulation. For those who want to create their family bank, I add a rider called the Early Values Agreement, which eliminates the surrender charges associated with the policy. But it also allows you to borrow more than double what you would ordinarily be able to borrow in the early years of the policy. Now, there is a common misconception that you can borrow from the death benefit, but you can only borrow against the policy's cash value, specifically the net surrender value. Let's say you contribute $1,000 a month into your policy. In year 5, you decide you want to buy a new car. Instead of going to a bank, you take a variable loan from your policy. This carrier will allow you to borrow up to 95% of your surrender value. So you take a loan for $50,000. That $50,000 is still in your account earning interest because you are borrowing from the insurance company using your cash value as collateral. You drive your car, make payments back to your own policy, and the interest you would have paid to a bank is now cycling back into your account. You didn't interrupt your growth, and you kept the wealth in your family. This is a client who is contributing $500 per month. He took a variable loan in October for $5,984 and paid it back. If he wanted to take another loan, he can take another variable loan for $11,639. Now, one important warning. Just because you can borrow from your policy doesn't mean you should overdo it. If you take too many loans too quickly or borrow more than the policy can safely support, you can drain the cash value, reduce the death benefit, and even risk a policy lapse. Always make sure there's enough cash value to cover the policy's monthly charges, and give your money time to grow. Now, what happens if you pass away and you haven't repaid the loan? Your beneficiary would receive the cash value plus the initial death benefit, minus any outstanding loans. Being your own banker isn't just about saving money, it's about creating financial freedom, independence, and legacy. If you'd like to see how this could work for you, click the link in the description below or visit my website to schedule a free consultation. And don't forget to subscribe for more strategies on protecting and growing your wealth.